Okay, we've come to a very important section, which is candlestick price bars. We already understand what an open, high, low, close price bar is, and the importance of it, how it's kind of the foundation. But the candlestick bar is a much better alternative, and really what people mostly use. There's a lot of things you could do with the candlestick price bars, and that's what we're going to learn about in this section. They're a better alternative, and they've been around actually for a very long time, since the 18th century. They're called Japanese candlesticks because they originated in Japan and were used by traders that were applying it to the rice market back in that 18th century. So this is not some new voodoo or anything like that. Candlesticks are well established and studied that you can use by understanding the pricing, but also how these different price bars interact with one another when looking for certain candlestick patterns, which we're going to learn about, as well as look at some trading opportunities. So we think about the open, high, low, close bar and the fact that it tells us a lot with regards to how the price moved throughout the day, but candlesticks will tell us this and much more. And in general, if we think about what are some of the benefits of candlestick bars, well, you'll see as we look at some examples, they're going to be a lot more visual. They're going to tell you a lot more just by instantly looking at it. And as you learn them, you're going to see that they're simple to use and interpret. Maybe not at first, but it won't take you very long before you can look at a candlestick and say, I know exactly what's going on, simply by glancing at it for just a second as you get more familiar with them. So they're simple to use and interpret and provide lots of information with just a glance, which draws a lot of people to use them over other price bars. So we'll learn about those and how to represent these patterns that are really good patterns for us to trade around and patterns that are widely known. So you can expect other traders to respond in specific ways to specific patterns, which is a good thing. If everybody sees the same thing, like let's say a Gravestone Doji, which we'll learn about, people are going to react a certain way. And that helps us as traders to see which way the market sentiment is, which way things might be going, and we could trade based off of that. And you can use candlesticks on any chart, and it can be used with other indicators, which is really powerful too. So you can use that candlestick and you can use other indicators like moving averages or other things that you'll learn throughout the course, and you could use them to kind of work together to give you more strength around your decision-making process of candlesticks, which really helps. And they can have dramatic shapes or patterns to them that really grab your attention and could potentially help you react faster. And they can also help you recognize certain turning points, such as an uptrend or a downtrend, just by looking at these candlesticks. So very, very, very important, these candlestick bars. Let's dive into that here in the upcoming lesson so we can learn more about them and how to apply them. The first thing we need to do when we're talking with candlesticks is understanding what they're trying to tell us, right? They're trying to tell us something, and so we need to be able to interpret what the candlestick price bar is trying to tell us. If you look at this example here, we have a red and green candlestick. These candlesticks are trying to tell us something about the pricing, the range of prices, and the opening and close, whether it was up or down. But we need to learn how that works. You can kind of see just looking at these two examples that the candlestick price bars get their name because they look basically like candles, right? You have that body that looks like the candle, the main body, and you have a wick on the top. The difference is in technical analysis, you can also have a wick on the bottom too, and they could vary in different lengths as you will see. But that's the idea. They kind of look like a candle. Now, the question is, what is it telling us? Give us a little bit more information so we can understand what this means. Now, we're going to look at how to interpret them. So if you look at these two here, what are they telling us? Let's start with the one on the left, or actually let's start in the middle here. We look in the middle where it says upper shadow, real body, and lower shadow. So all candlesticks share these, the upper shadow, the lower shadow, and the real body. They have all three of those variables. Some are different lengths, of course, but in these two, they're exactly the same length. The upper shadow is basically that straight line that you can see on the top of the candle. The real body is the rectangle, also referred to as the body of the candle. And the lower shadow would be like the wick on the bottom part of the candle. So an upper wick and a lower wick accompanied by the body. You'll see though, they could vary in size as far as height. So now if we look at the candle on the left, the red one, you can see that the high of the price on that day is at the top of the wick, at the top of the upper shadow. So that's telling us in this price range that that would be the absolute high that security traded during the day. If you jump to the low at the very bottom, you can see the other wick where it's going towards the bottom. that would be the absolute low in terms of prices for that day. When you see these on the chart, you'll see the different prices and things, and you'll see all these candlesticks, and you'll see their highs and lows based on their wicks, the upper shadow and the lower shadow. Now, the body itself tells you something as well. So the one on the left, you can see at the very top of the rectangle, at the top of the body, that's the opening price. Now, the body itself tells you something too. So on the left, you can see at the very top of that rectangle, at the top of the body, that is your opening price. So that line, that horizontal line, would represent what the price was at the opening of the trading day. Now, at the bottom of that rectangle, it would show you the closing price, what the price was at the end of the day. And then the color of the candlestick actually has meaning as well. So you can instantly see if the close occurred higher or lower than the opening solely based off the color of the candlestick. So you're really starting to see how these candlesticks can give us so much information just at a quick glance. Now, if you look at the candle on the left there, it's red, and it's telling you that prices closed below that opening price. So the prices open higher, but at the end of the day, when prices closed, they closed below that opening price. So just by looking at that candlestick color, you can tell if it was a down or up day. So if my open is lower than my close, we had a bad day, and that wick is telling me my high and low. The same thing on the right hand side with the green one. The difference is that close was higher than the open. You can see that on the real body, the top represents the closing price, which is higher than what it opened at. So opened at where the open price was in the picture, then it had a range of highs and lows throughout the day, but then it finished the day higher than that opening price. So the way you can tell that instantly is by seeing the body is filled in with green. So I know if I see a red body in this example, I know that I had a down day, right? It opened and then closed lower. Now if you see a green body, I instantly know that we closed up higher than at the open. It may seem a little confusing at first, but it's not too bad. You'll get the hang of it here rather quickly. If you look at, let's say, if something is bullish, as in prices go higher, you can see here's that representation of the open being lower and the close being higher. Bearish would be where the candlestick is typically red in color and would show an opening higher than the closing price. So it's bearish or a decreasing type of candlestick. And these candlesticks can be green or white. That would represent bullish, whereas red and black would represent a bearish one, depending on the price chart you're using, the platform that you're using. To demonstrate what it would look like as far as with an open, high, low, close price bar versus a candlestick price bar, and look at the candlestick bar chart as an example, and you could start seeing that they have these different heights, right? See how some are really short and squat and some are real long. Some have those real long wicks at the top, where some with no wicks at the top or very little, but with long wicks at the bottom instead. Now, one thing with candlesticks is there are things that can be indicated that give you more information just by looking at the pattern or the shape of the candle itself. So here's a closer look at the candlestick bar chart as an example, and you can see how the candlesticks have varying heights, right? So some are really short and squat, whereas others are long, and some have real long wicks at the top versus some that have very little wick at the top or have a majority of the wick at the bottom instead. In fact, you could see this one over here on the left, just after the price thrust up, you can see a candlestick that is pretty short with regards to height, and there wasn't much of a difference between the opening and closing price. It almost looks like the body is just a line that's going across. This is what's referred to as a Doji candlestick. And these are candlesticks that we trade around, which are considered to be a special case as where the open and close are occurring within the same vicinity or area. So we're going to learn all about dojis here coming up because they're very important in terms of, recognize a trading opportunity. But the real takeaway from that is to understand that these candlesticks can have different shapes. And they're trying to tell you something when you look at them both within their own individual candlesticks. But also when we start looking at patterns or of candlesticks coming up, they're going to give us a lot of trading information. And some people, all they do is trade off a candlestick. So it's all they focus on is candlesticks. I like to use them in combination with other indicators personally. I just think it's very powerful. But a lot of people, they just love candlesticks and these different patterns they offer, and that works well for them. So let's look at these interesting situations that occasionally come around called dojis. And what are they trying to tell us? And more importantly, how can we use them to be better traders? So a doji is a situation where a candlestick has no real body or a very small one. And the reason that happens is that the opening price and the closing price are at or very near the same level. So if you look at this graphic here of a typical candlestick, you can see that it has a pretty good sized body. It has a real body, and the rectangle part has a wick at both the top and the bottom. And as you know from the previous lesson, those wicks are referred to as the upper shadow and the lower shadow. Now, if you look at these doji candlesticks, one has the open and the close more towards the bottom and not much of a candle body there at all. I mean, there's a body, but it's like they're almost exactly at the same price with regards to the opening and closing. You're not going to see that width of prices between the open and the close because they're all close together. Same thing with the one on the right, the far right, where the price opens higher and close near that high as well too. So there's still a range. You could still see that vertical main line down the middle. There's still a long wick running through and affect the entire candlestick with a high upper shadow and a low lower shadow. But the doji is showing a very small candle itself. The body is showing that the open and close occurred very close to each other. And because that happens, we can learn things around that. Now, on its own though, a doji doesn't tell you all that much. Just looking at it alone, in space. Other than that, there's indecisiveness in the market, right? There's no clear direction of where price is headed. And really where a doji gains its meaning is based on the bars preceding it. What is happening before it? Because a doji can help indicate that a transition may be coming and what type of transition depending on the type of doji. So think of it that way. Don't think of it like I see a doji, I need to do something. Think if I see a doji, I need to look backwards a little bit to see what might be happening next. And that'll help me with my trading decision. Do I buy? Do I sell? What do I do? So dojis kind of work along with other price bars. So a doji that occurs after a prolonged uptrend, meaning buyers have been in control, creating that long prolonged uptrend, the prices have been rising. Now when you have a prolonged uptrend and you see a doji form, that could mean the buying or bullish enthusiasm is coming to an end as far as a doji occurring after a prolonged uptrend, and that might be the end of that trend, and that's referred to as a bearish doji star, right? Bullish means things are going up, whereas bearish means things are coming down. So we have this long uptrend, and now you start to see a doji or dojis forming that might show some indecisiveness in that we might be ready to make a move now in the opposite direction. Now, a doji after a prolonged downtrend, the exact opposite of that, where we've been going down for some time, means buyers might be coming in and they're getting more enthused about that security and they're starting to buy that security, and that prices might be ready to start coming up. So it's been going down. We've had a series of red bars. There's now a doji that might be appearing, showing some indecisiveness and maybe showing us that we're ready to make that turn and go back upwards. And that's called a bullish doji star. So you have bearish doji stars, bullish doji stars acting in the opposite ways. But that's the idea of these doji candlesticks. They could show you where these changes might be occurring. So what do we learn from that if we think about it now a little bit closer? What we know is that a doji is kind of a transitional indicator. It's not a continuation indicator. A trend is going to continue. If anything, it's going to tell you that a transition may be coming. That the trend, whether it's going up or down, is going to change. So if you're investing along a certain trend, let's say a buying trend, you want the prices to keep going up, and you start seeing a doji, then that might be telling you, it might be time for me to sell and get out because that upward trend might be willing to change. Again, they could be up or down. It depends on where the trend is going. And the stronger the previous trend, the more likely that doji is actually going to correctly signal a change. So if it's not a very strong trend, it's kind of in and out, it's not that strong a trend, that doji may not be as impactful. But if you've had this long, real strong bull upward trend and you see a doji, there's a higher chance that doji will be correct, signaling that change and transition. Now again, nothing's perfect, but something you definitely want to be aware of and maybe, adjust your trading based on that. And then lastly, in the next lesson we're going to learn about, there are certain doji shapes that actually have extra meaning. So we know a doji is going to be a transitional indicator and that trend might change. The stronger that trend, the more likely it will change. But then how that doji looks could provide even more meaning. So that's what's coming up in the next lesson around doji candlesticks. Also, in our previous example where we saw a couple of dojis back to back, did it signal that there was a change in trend? Well, not really that much because the trend before it was not really fully formed. It was not a strong trend. You saw the trend where it was kind of just a couple weeks of price moving up. So there wasn't really this strong established trend leading up to that. So it didn't really make a transition, but it was definitely something to still be aware of. If I were looking at this chart, I would have said, okay, we started trend up. I see a few dojis appeared. I would be watching it, and then I would recognize that the trend continued up. Price closed above those dojis, telling me, okay, price managed to push up even with those dojis having been in the way. So maybe we are going to get a nice strong uptrend out of this. So a special shape around a doji can occur around the shadows. Now, remember, the shadows are the wicks of the candle. The upper shadow being the upper wick, and the lower shadow under that real body would be the lower wick, like on a typical candlestick. As you can see, doji candlesticks, they have their highs and lows, of course, and they have a range of prices. It's just the open and close are near each other. But when we look closer, what might be happening at the top part of the wick versus the bottom part of the wick, either one might be able to tell us a little bit more information. And there's certain doji patterns or indicators around these shadows that can give us more clues as far as to what might be happening next. Let's say you have very little or no upper shadow. That's an indication that something's happening. Or if the upper shadow is extremely long or tall. Those are situations where you have a doji and the different lengths of the shadows can be very impactful. They could tell you something as far as, what to expect based on patterns seen previously and how they tend to unfold. But the main thing is you want to watch for these patterns because dojis can be pretty rare, but if you see them, they might be a great opportunity. So let's look at these common doji shadow patterns, and again, looking mostly at the wick and see what that might be telling us. So the first one here is a Dragonfly doji, and if you look at just the candlestick image here for a second, what is it telling you? I mean, I guess it looks like a T, right? But it's really telling you that the open and high and close were all the same, right? A doji by its nature, the open and the close would be similar or at the same. But in this case, that the actual high was the same as well. So not only did it open at the high, but it closed at the high as well. So you have this long lower shadow doji, right? So that lower shadow below is very long, and that's what makes a Dragonfly doji. And really what's happening here is the price opens and sellers are really trying to drive that price down. They're trying to see if somebody will sell for less and establish a new low. They want the close to be below the open and to try to establish a new low, but they fail to succeed. In fact, not only do they fail to succeed, but price pushed right back up to the point where the stock started initially at the beginning of that day. So how do you interpret that? And by the way, you always need to look at the candlesticks preceding that doji to interpret it because they don't tell you much on their own. So you always look at the bars preceding, the candlestick preceding it. So if the preceding bars were in a downtrend, then buyers are emerging and the downtrend may be ending. So think about it. It opens lower because we're in a downtrend and they try to go lower still, but the buyers say not so fast. They come in, they drive that price back up, which causes that long lower shadow to form. Now, if the preceding candlesticks were in an uptrend, then sellers are emerging, preventing the buyers from moving to a higher price, and that uptrend might be ending because of that. So think about it. We open, buyers are looking to push higher, but they're quickly overwhelmed and price drops pretty sporadically. And although price closed at the high of day, it's telling you now that sellers are looming, and it's showing that this uptrend is under pressure and could potentially be at its end. So again, the doji itself, you can't look at that and make a trading decision solely off of it. You always have to look at the preceding candlesticks and identify whether they're in a downtrend or an uptrend. And you'll see that with some of the other examples here as well. So that's the Dragonfly doji. Let's look at a Gravestone doji now. So if you look at this one, it's kind of the exact opposite, right? You have a long upper shadow, so a long upper wick. The open and the close were the same or approximately the same. Again, that's the whole concept of a doji. If you had a real thick body, then that's not a doji. But this one is because the open and the close are the same. There's no real bottom shadow. It's all upper shadow. And so what's happening here is buyers are trying to drive the price up and establish a new high, but they fail to succeed. They drive it up throughout the day and then they get crushed right back down. So again, we're going to look at the preceding bars. And if the preceding bars were in an uptrend, what's happening? Well, sellers are emerging and that uptrend is under serious pressure and could potentially be at its end. So buyers are trying to push it up and sellers are just overwhelmingly strong. And pull that price right back down to the opening level. And so that uptrend might be ready to transition or end. Same thing when the preceding candles are in a downtrend, but instead this is showing buyers are emerging, preventing sellers from moving that price lower, and that downtrend may be ending. So although that candlestick is showing sellers are still technically in control, it's also showing that buyers are now starting to apply more pressure. So it's an indicator that things are happening and a transition might be on its way. So candlesticks are great because they can tell you a lot by just looking at the real body and the upper and lower shadows, right? They're telling us what might be happening with prices that day and what might be happening in a series of prices. So by themselves, they can tell us quite a bit. But when they're paired with a pattern of other candlesticks, they could tell us even more. So we looked at the Gravestone and Dragonfly candlesticks and said, you always have to look at the preceding trends. Was there an uptrend or was there a downtrend prior to that candlestick appearing? But there are also patterns of candlesticks where you can see certain things happening in terms of patterns that can be very helpful. A very helpful indicator themselves. And you could trade off of those patterns. Now, two candlestick patterns might have different meanings, depending on where they fall in a series themselves. So not only the individual price bars, but that candlestick pattern is part of a larger series within an uptrend or a downtrend. And we're going to learn all about that and make it very clear. And I'll tell you, people really like to focus on candlesticks themselves and trade solely off of candlestick patterns. As you learn the patterns, they become pretty easy to trade off of. And they also work well with other indicators like a moving average or something along those lines. And we'll learn throughout the course, and you're going to see just how indicators compare with one another and have a good synergy. So let's start looking at some of the real common candlestick patterns that you want to be watching for and learn the certain actions that you want to take to help you become even more profitable in your trades. Two of the most well-established and really classic candlestick patterns are the hammer and the hanging man. And we're going to take a look at those and learn how to recognize them. And you're going to notice that they're fairly frequent that you're going to see them on a chart. And oftentimes people who really enjoy trading candlesticks will prioritize that hammer and hanging man solely. And that's simply how they trade. So in a hammer, you have an established downtrend. You can see here how we have those 4 red candlestick bars which have closes that are lower than their opens and have lower lows each day. And then a hammer forms, which is going to mark the end of the downtrend. And what you'll see form is a candlestick with a long wick on the bottom with minimal wick at the top, if any. And the body of that candlestick is going to be no more than 1/3 of that total wick length. So you're looking for that long wick on the bottom. And what it's telling you is that the sellers are able to create new lows, which is why you have that long range to the downside. But buyers eventually overcame the sellers and pushed that stock up, closing near or at the high of day. So it started off the day with strong sell pressure, as if that trend was going to continue. But now price is really kind of at its exhaustion level, and buyers are looking at this as an opportunity or a good opportunity to buy. And then they push up from the lows of the range, which is a pretty long range, and actually manage to close price higher than where it opened, thus changing the color of the bar to green. And then you'll see it kind of being confirmed over the next couple of days. Now, you do need to remember that you need to let that trend form, but this is a good recognition that something is going to happen. And you could see over the next couple of trading periods that now we get more into an upward trend where we are developing higher highs. So when looking for a hammer, you're looking for that downtrend and then kind of a reversal from there as buyers step back in and try to move things up because they believe price is too low. Now the hanging man is essentially the opposite. You have an established uptrend where things have been trending upwards. Each close is higher than the previous, giving us those green candlesticks. But when a hanging man forms, it's marking the top of an uptrend. And if you own that security, that's the time to sell or at least take extra caution. This isn't your bullish hammer where you're looking to get in and start riding a new uptrend. It's a hanging man, which is just the opposite. And it's signaling a red flag for that trend and for you to watch closely the coming days because this might be the time to sell. So what's happening is the bulls, which are those who have faith in the security, are unable to keep the bears from making a new low. So in other words, buying pressure is now becoming overwhelmed by the selling pressure, and that's what's being depicted by the candlestick formation. This candlestick looks just like the previous one with the long width at the bottom and a shallow body at the top, but the difference is in where the candlestick is forming. It's forming after an uptrend. Also, in this example, the body is red, meaning that the close was lower than the opening, so sellers had more momentum into close. Now, technically, you can have a green or red hammer at the top of a trend, and it still depicts the same thing, which is buyer momentum is waning, but a red candle over a green candle would obviously act as a more bearish indicator. So now we're anticipating a reversal, and you'll see that play out where now the candlesticks afterwards continue down. Now, oftentimes these hanging man candlesticks mark as a temporary top in an extended trend. So price may fall from that level for a couple weeks to digest the previous move up, and then we'll resume that initial trend later on. So it doesn't necessarily mean that that stock is going from a long-term bullish trend to a long-term bearish trend. It could also just mean that that stock needed to catch its breath, and the same thing goes for the hammer. So it doesn't mean technically that the long-term downtrend will now shift to a long-term uptrend, but that previous trend may have needed just to pause for a bit before continuing. So for a short-term trader, one who trades on a time frame of a couple days to weeks, these patterns are great to trade off of, but for medium traders, let's say a couple weeks to months, you want to be cognizant of the fact that no trend can go up without pause, and that these patterns are often what can mark that pause is around the corner. So when it comes to these patterns, you always want to see where they are relative to the current trend. That's the key part. Let's talk Harami and engulfing candlestick patterns. Now, they're similar, but obviously they have their differences, of course. And we're going to start with the Harami. And the Harami actually means pregnant in Japanese. And the reason why is because the Harami pattern is formed when a small-bodied candle follows a larger-bodied candle. So you can almost imagine it kind of looks like somebody that might be pregnant. And that's kind of the idea behind the Harami, when that small candle almost looks like the bump that forms at the belly of the previous big candle. And it's important to look at the color makeup of the candles. If it is a green candlestick followed by a red one, that would indicate a bearish sign, whereas a green followed by a red would indicate bullish. So in our example here, you can see that we have that red candle followed by a green one. So this would be considered a bullish candlestick pattern, and you can kind of guess at that because you can see that there's an upward trend following afterward. And a Harami basically acts as an indication, and it's telling you that a change in sentiment is coming. So if you're looking for an indicator to signal there may be a reversal around the corner, then Harami's can be very helpful for that. And the smaller the real body on that second candlestick, so that smaller one, the more powerful of an indication that a reversal is coming. Now, if there isn't much of a difference between the two candlesticks, say the first candlestick is pretty big and the second one is relatively large too, or just like medium size, then it's not really a Harami. That second candlestick needs to be pretty small relative to the previous one, just like how we have in our example here. So you're looking for that longer, taller, long real body candle followed by a small candlestick. And a Harami is acting as an indicator that there's a change in sentiment coming. So if you're looking for an indicator to signal that there may be a reversal around the corner, Haramis can be very helpful for that. And the smaller the real body on that second candlestick, the more powerful of an indicator that a reversal is coming. Now, if there wasn't much of a difference between the two candlesticks with regards to size, say that first candlestick is large and that second one is kind of like medium sized, then you're not really looking at a true Harami. That second candlestick needs to be small. So that first one is going to be a taller, longer real body candle, whereas the one that follows is going to be a small candlestick, just like you have pictured here. And you're looking at the real bodies of these candles a little more so than, let's say, the wicks going up or down. So if you're looking at this Harami, you'd think, okay, we can see that we've been in a definite downward trend, or we've had these 3 red candlesticks in a row, and now all of a sudden, this candlestick with a narrow trading range forms. It's a green-bodied candlestick, so the close was higher that day than the open. So we recognize now that we have this large red-bodied candlestick followed by a small green-bodied candlestick while in a downward trend, which tells us that change might be coming. Now, as we know with trends, we want to make sure we let the trend develop. We could see this and say it's definitely a Harami, and it turns out just to be a false signal. It's not a Harami at all. So once we see that second day, and certainly that third day, now we're starting to see more of a confirmation that there's a real trend reversal that has occurred, and we can now look to trade off of that. How soon you get in is completely up to the individual and their risk tolerance. So if you're more of an aggressive trader, you may want to get in the second you, let's say, break above the high of that big bodied candlestick. Or if you're more of a conservative trader, you may want to kind of just sit back and let things kind of firm up a little more with regards to the trend, and then get in at, some sort of pullback or something along those lines. But the key takeaway with regards to this candlestick is you want to have a large bodied candlestick followed by a smaller bodied candlestick. If that large body is red followed by a green candlestick, that would be a bullish reversal. Whereas if it is a green bodied followed by a red bodied, it's a bearish reversal. Just like a Harami, engulfing candlesticks will also signal a reversal of trend. So you're looking at trends and you're seeing if it's going to continue or be changed. And that's how engulfing candlesticks work as well, just like Haramis. But if you look at the images here, you can see that it's quite the opposite. You don't have that pregnant type look. You have a smaller candlestick being engulfed by a larger one. And that's the key thing. You have to wait for that second bar to occur. You can't, let's say, be in an uptrend and guess for a reversal because you see a short-bodied candlestick form on its own. It could just be as much as a little pause before that trend continues. You always need that second candlestick. Now, essentially what's happening is there's a candlestick with a wider range that develops the day after you have a smaller candlestick with a tight range. And if you look at either of these examples, you can see that the second day, the body is bigger and it completely engulfs that previous candle. And that's the key thing here. It's going to completely cover and engulf both the opening and the closing of the day before. And if you have a higher opening and a lower close in this engulfing candlestick, prices are expected to start heading down from there. Now, if we have a small candlestick that is then enveloped by another one with a lower open but a higher close, then that would be a bullish signal, and then prices are expected to start rising. Now, with both bullish and bearish engulfing candlesticks, you're looking at the previous trend because this is all about trend reversals. They work really well when there is a trend that's established, but they're not so reliable when there's no trend yet at all. So if we look at the example up at the top with the bearish engulfing, we've got a nice strong trend. We have higher highs going there. Even that small candlestick at the top put in a higher high. So everything up to that point looked great. And then all of a sudden, what happens? You have this big engulfing candlestick. So you see that it engulfs the previous day. You have this big red body where the opening is higher than the day before, but the stock then closes lower than the close of the day before, giving us that red candlestick body. And this is telling us that there's a pickup in selling pressure. And that's where you need to wait for the next one just to confirm it. Some people trade right when they see that engulfing candlestick, and that's fine. You're just taking on additional risk there. There's more of a chance that it's a false signal at that point, but you could certainly do that. If I look at, let's say, the second red candlestick that's pushing outside that box of the bearish engulfing, I could see, okay, now we're putting in lower lows. And now I think that we've got a true bearish reversal on our hands. And at that point, if you owned that security, you would want to sell it. Or if you were looking to short the security, you would look to enter. Now, say you find a stock that's in a downtrend and it formed a bullish engulfing pattern. So we have a definite downward trend with all those red candles. Then we have a lower low, a short body in the red that's then engulfed by this nice big green candlestick, the real body of that candlestick. And so we have our closing that's higher than the open and the close of that red candlestick. So everything's being engulfed there. We wait for the next candlestick outside of the box to give some confirmation, some follow through. And then we could tell that, okay, this is in fact a trend reversal. So when you start seeing things like engulfing candlesticks, think, is there a trend and is that trend starting to reverse? And then you want to wait for it to happen. You kind of just want to sit back. You're going to lose a little bit of opportunity cost where maybe you could have gotten in a little bit earlier should you have not waited for that second candlestick outside of like the box, kind of like the one that confirms it. But at the same time, you're going to have far less losses and you're going to avoid a lot more false signals. So it's really good to let these engulfing candlesticks kind of truly, form a little bit and have that second bar confirm what you're seeing. And it's overall going to increase the odds of it being a true reversal. So shooting star and window candlestick patterns are very interesting patterns themselves, and we're going to start with the shooting star. So a shooting star has a small real body and a long upper wick. And what it's doing is it's implying the failure of a trend to continue, failure to close near the high. So price pushed its way all the way up to the top of that wick before retreating back down to close below its opening price. So you can see in the example here, we have a green candlestick that's on the far left, and let's assume we had several more before that, therefore putting us in an uptrend. We then have a doji that follows, kind of just threw that in the mix because sometimes you'll see shooting stars form after dojis, which makes perfect sense since dojis imply indecision amongst traders on the future direction of the stock. Now, at this point, we haven't had a real, let's say, reverse or anything, but we have a doji saying we're getting a little indecisive at this point. It can either keep going up or reverse down or go sideways. You just have to watch. And then all of a sudden we see this shooting star form, and we see that basically there is a high established as far as the opening, which gives us that long wick, but the close was lower than the open. And that's why it's a red candlestick, because the close is lower than the opening of that day. But in that candlestick with the long wick at the top, you could see how it fired up almost like a shooting star before basically crashing back down. So we know there's a lot of people that were trading at much higher prices that almost got trapped up there. So at this point, we just want to wait to see what happens next. We know that we have a candlestick that could potentially mark the start of a reversal, or we could simply go sideways. If you own a security at this point, you would want to be aware that it might be time to consider getting out due to the formation of that shooting star. A falling signal would be the exact opposite pattern. By the way, if you were looking at, let's say, a falling star, that would be considered a bullish signal, whereas this shooting star is obviously more of a bearish signal. So different type of signal that basically looks the exact same thing. It's just flipped upside down, and that falling star would be in a downtrend rather than an uptrend. A different type of signal is one that works with gaps, and they're called the rising or falling windows. And really what you're seeing here is you have a gap up, which can be in the form of a breakaway gap or runaway gap. And to start with the rising window, what you're really going to see is a gap followed by two bullish candlesticks. And what brings such significance to this type of price action is that on the third day, there is no attempt to fill that initial gap up. So at that point in time, you're seeing a strong display of strength, and buyers are showing that they're in complete control. Now, oftentimes people may anticipate that that gap can get filled on the third day, and they may rationalize that by saying there wasn't enough volume or whatever it may be to be considered a breakaway gap or runaway gap, and they may be right, but should there not be that gap fill on the third day, it's telling you that you have a true breakaway or runaway gap on your hands. And this would be in the case of what you would call a rising window pattern, where that gap is left unfilled and the upward trend continues. So you're kind of looking for this pattern in this example where you have a rising window, where that gap remains unfilled, giving you strong odds for a continuation of that trend. Same thing with a falling window. You're really looking at a gap down, right? We're looking at bars from left to right, and we could see that we have a downward trend. That's the red candlesticks in the falling window versus the green candlesticks in the rising window. So we have our initial red candlestick followed by a gap down, and they're both red. So they're both going downwards. Our prices are falling. And then that third day, price makes no attempt to fill the gap, right? So we now know that bears are in full control at that point in time. And so that's more of a falling window and really kind of a confirmation that the gap is a true gap and that that trend is really being established. The trend is taking form. And again, breakaway gaps are going to be creating new trends, whereas runaway gaps would signal the continuation of a previous trend that we're not seeing on the images here, obviously. So look at the gap lessons again, reinforce all the material with regards to gaps, because gaps are an extremely powerful trading tool. But to conclude, rising and falling windows are essentially telling you the trend is going to continue after that gap up and really be established versus coming back downwards and filling that gap, and that's what we want to watch for. Let's take a look at the three soldier pattern and its counterpart, the three crow pattern. And essentially the three soldier pattern would be three green candlesticks in a row. And you have an upward trend. You've got these three long green bars. That's the key thing to really look for. Those three long green bars that are all in a row, kind of lined up like little soldiers, right? So what this is representing is a continuation of the trend. And really what you're looking for is that there are longer green bars, and the consistency part is also very important too. So they're going to be very orderly. It looks like they're almost within a marching formation, so to speak, or at least marching upwards in formation. And that's a continuation of the trend. That's the indicator that you're looking for. And a more significant indicator would be if the top wicks of these candlesticks were to be short or non-existent. So we're seeing that close remain near the high on all 3 days. So we don't have any real long wicks showing that price went up real high and then got crushed back down by sellers. It's just like a little formation of soldiers moving in formation upwards. And really, the key thing you're looking at in this pattern is that consistency between the bars. Both these patterns are looking for that. Not a whole lot of up and down, just real orderly movement. And so that shows a strong and clear trend is going to continue in that same direction. Now, it could be in the opposite direction, a downward direction. And then we'd be looking at the 3 crows pattern, and the candlesticks in that case would be red. Both patterns share the same characteristics, but basically in reverse. So you're looking at longer red bars that need to be consistent with one another in a row, much like the 3 soldiers formation. Not sure why it's called 3 crows, I guess because they feed on the dead. I don't know, but this pattern is basically going to mark the continuation of a downtrend, so prices are going to keep going down. Now, that pattern becomes a stronger indicator if the wicks are short at the bottom of the candlesticks, showing that, the closes are already near the low and sellers are in control. So it's the opposite of the 3 soldiers. So real consistent red bars in the same direction. The shorter the wick, the better the indicator. And again, when looking for both these patterns, what we're really looking for is that consistency, which is why the number 3 is really important here. Because 2 can give you an idea of potential direction, but you striking 3 and all with consistent length is giving you a real proven pattern that's telling you more downside is to come. Now, nothing is perfect, of course, but a real proven pattern shows that we're moving in a direction, either with the soldiers going upwards in a trend or the crows going downward in a trend. So look at these patterns. I hope you enjoyed this powerful section on candlesticks and candlestick patterns, and I'll leave you with some final thoughts. Candlesticks and candlestick patterns will start to become like second nature to you the more you're exposed to them. So if it seems a little difficult to grasp it right now, you can always go back and watch a lesson, and the more you see them, the better your eye will be trained to pick them out, and you'll start seeing these things very, very easily, and it's going to help you to become a successful trader. So some final thoughts around this. You want to continue to learn and practice to visually recognize what these candlesticks are trying to tell you. They're trying to tell you something. So the more you understand the candlestick's behavior, you will not only understand what's going on, but be able to decide to get involved or not a lot quicker. So training the eye on what to look for and understanding what to expect will be very helpful, and that will come as you learn over time. Also, there are a lot of candlestick patterns out there. I shared the most common classic ones that almost everybody can use, but there are a lot of different patterns out there. In fact, I think there's too many patterns, and trying to incorporate too many can almost be detrimental because some are not, as you know, as statistically valid as others. The ones I've shared with you are the ones that are the best, so be sure to do your own research prior to implementing new ones into your technical analysis routine. Also, just be mindful if you're trying to learn too many patterns, you can steepen the learning curve because you're trying to keep all these patterns in your head, and that can actually impact your trading in a negative way. So less is more. Just try to keep things simple. Focus on a few different patterns and start there, and then you can add additional ones down the road if you choose. But too many can be detrimental and cause analysis paralysis, which is when you try to factor in too many at once, or you may have conflicting patterns, and it will cause analysis paralysis, which is when you basically fail to make a decision within the meaningful time frame and miss your opportunity. And as I mentioned in a couple of the lessons, some people only trade candlestick patterns. That's like their primary focus, and that's okay. You could be successful that way, but I would take some of the other lessons that you're going to learn and think about if you would rather incorporate some of the other indicators to help out or stick solely to candlestick patterns. And by the way, some of these patterns are not as common, so your trading may not be as frequent. If you're looking for just a certain doji setup or a certain pattern setup, it might not be as common as other types of patterns out there. But a good practice too is as you learn new material throughout the course, combine candlestick patterns with those new indicators to get additional confirmation. So maybe I see a candlestick pattern forming. I might confirm that with what I expect volume to do at that point in time. It could be rising, falling, or staying the same. So the trading volume is there confirming, but I might want to confirm it with other things. I'm learning like trend lines, moving averages, weighted moving average, simple moving average, general trends, upward trends, lower trends, moving averages, momentum indicators. There's all kinds of different things, sentiment indicators. These things that we're going to learn throughout the course are things you could use that if you see a pattern from a candlestick aspect, you can go outside that to something a little bit different and say, okay, I see this is happening. I'm going to use a momentum indicator and see if that actually confirms what I'm seeing here. That both my candlestick pattern and my momentum indicator are saying prices are likely to rise. Then I'm going to buy because I'm getting a double confirmation, and we'll learn all about that stuff towards the end of the course when we talk about setting up your own strategies and stuff. But right now, we're just learning the tools and how to apply these tools so you can be a successful trader. And I'll tell you, candlestick patterns, this is a great section here, and they could really, really make a difference in your trading and help you to be a very successful trader. So let's learn about some other indicators and ways to interpret using technical analysis.